Hey, welcome everyone. Hey everyone, welcome to Transform with me, Greg Carson. I'm going to. This is a podcast that's focused on that's going to explore the transformation of market ecosystems and everything else. As a reminder, any views or opinions expressed by me or our guests are our own and do not represent the views of Humla Ventures or their companies. The content provided in this podcast are for informational and educational purposes only. It's not intended to be financial advice, and guests are not speaking as financial advisors, and any decisions you make based on the information on this podcast are your own risk. Before making any financial decisions, consult with a qualified professional. The hosts and producers of Transform are not responsible for any losses or damages resulting from your actions based on the content of this podcast. Thank you. It's my pleasure to interview Justin Burden, Senior Managing Director of the world-renowned Industry Ventures since 2004. Industry has over $6 billion in AUM with a specific focus of venture secondary investing. Justin originates, values, and manages secondary investment opportunities in later stage venture-backed companies and venture capital funds. He's on the investment committee for the Industry Ventures secondary and tech buyout funds, and is also actively involved in fundraising and maintaining limited partner relations. Justin has sourced and led the acquisition of over 75 secondary transactions in both directs and limited partner interests. These transactions include purchasing corporate venture capital funds, hedge funds, investment restructuring, limited partnership interests, acquiring portfolios of limited partner interest, and purchasing founders' equity, and structuring special situation investments with general partners and limited partners. So Justin is a long-term friend and business associate of mine, and we are very lucky to have him today. It should be very interesting for both CEOs or alternative investment professionals or allocators. So let's start with the in-depth, important questions, Justin. Welcome.
Great to see you, Greg, and I look forward to our conversations about the venture market.
Okay, so we've done some research, and we're going to start with the most important question, which is we understand that you actually, this is the second appearance in front of a Carson. You were on the Tonight Show with Johnny Carson during high school. So tell us about that first.
That's great. You dug that out. I haven't heard that in a while. It used to be the number one interview question I always got right out of college. But yeah, in the in the early 90s, there was a tradition at the high school I went to, Piedmont High School in Piedmont, California, that there was a bird calling contest. And the winners, the top 6 winners, got to fly down to LA from the Bay Area each year and get on to Johnny Carson. And it was Johnny Carson's last year, 1991.
Oh,
and so
wow.
I got up there and had about 30 seconds on national TV.
Oh, fantastic. So you're a veteran of this stuff.
Yeah,
does that mean that can we hear a bird call?
We can't hear a bird call.
Okay. Maybe next time. Okay.
Yeah.
Cool. Well, I guess basically the podcast today, I'm hoping we're going to explore a little bit about your background, about what you do at Industry Ventures, about your thoughts about the industry. We're in a very interesting time for investing with international macro as it is, and strange things happening. But I think what's on people's minds for this podcast, because you're in a very special sector. So can we just start with a super basic question, which is like, what are secondaries and what are venture secondaries? Like, how do those play?
Yeah, great topic. And I think, as you're taking a step back here, is we're involved in the venture capital market, and venture capital is what we all think is a really fun sector to be a business person in, and backing private companies that are disruptive and going after big markets. But if you look at the stats, and as we know from the last 20 or 30 years, venture can be very challenging from a direct basis. The odds of getting a winning company typically in any portfolio are 2 or 3 investments out of 10. And so when we started Industry Ventures Secondaries strategy in the late 90s, early 2000s, it was really to go about a different way of getting exposure to really exciting venture-backed businesses. And that is, to your question, through secondaries. And so
Hmm.
our whole thesis in the secondary thesis is, let's just go after the already successful venture-backed businesses that have the typical venture risk taken out of the equation. There's so much venture risk. It's whether the management team can really execute and build and hire, whether the product or the service or the technology is actually going to work, whether people and businesses are actually going to buy it. We wanted to take that all out of the equation and buy into already these successful businesses. So businesses that have at least 30 or 50 million of revenue, that are at least 7 to 10 years old on average. So they've been executing in the market. They've built out their teams. They're venture backed, because we want the boards to be controlled by similar institutional venture investors where our interests are aligned, not only on governance, but also on exit and exit timing and exit valuation to make sure we can get our returns. So secondaries for us was a way to play venture because we wanted to be in the venture investment business, but we wanted to do it in this different way. So when we started doing this in the early 2000s, we really were on the forefront, one of the few players doing it. There were a lot of secondary funds. There was over 30 or 40 billion-dollar funds probably at the time, but they really just were focused on private equity, buying into the big buyout funds through LP interests. And so we came about it differently by doing it directly, by buying shares directly from selling shareholders in these successful business, but also doing it indirectly by buying LP interests. So we had this hybrid approach, but at the end of the day, it was really about getting exposure to these great businesses.
Okay. And when you say secondaries, does that mean that you are, why don't you explain what you mean? Like, who are you buying these shares from? And how does that transaction happen?
Yeah. And so secondaries is a really broad term, of course. And so in venture, when you're a venture investor, you're a venture fund, or you're a high net worth family or individual, or you're a corporation, which were really the 3 main players in the late 90s, you would give the money to the company and it would go to their balance sheet, and the use of proceeds would be to grow the business and build out. And
Right.
you would get ownership, you get shares and an ownership percentage in the companies. Secondaries, very different, of course, is we're buying from those existing shareholders. We're buying their shares from founders, from corporates, from venture funds, from employees. So our money is not going to the company, it's going to the selling shareholder. So in a way, it's a little bit net neutral to the company, but we pitch it to these companies that it's a positive, that a founder is selling and they're getting an institution like ourselves that can support the business, or an
Right.
old venture fund is selling and we're coming in with fresh capital and can support the business if they're going to raise capital going forward. So a secondary is this indirect approach. And so it just came about in the 90s as a theme and an investment class in the venture business.
Wow, great. And who are the and how does Industry Ventures sit in the competitive landscape, like compared to other companies like Ardian or Collar or Alphavest or other people that mention secondaries or second direct? What is your positioning in that field?
Yeah. So on a high level, those are our peers. Of
Right.
course, they're much bigger, but also they're 95 to 99% focused on private equity. Ardian, Collar,
Right.
Pomona, Goldman, these big players are really putting to work these billion-dollar funds by buying portfolios of limited partnership interests in private equity funds, the big funds. And so we sit within that broad secondary category, but we're 100% focused on venture. So we're very unique. And then we're also very flexible. We buy secondary directs from selling
Hmm.
shareholders. We buy limited partnership interest. And then really over the last 10 years, we've been at the forefront of this new other deal type, which is these tail end venture fund, GP continuation vehicles, helping old
Hmm.
venture funds continue, or helping corporate venture arms spin out. And that's a whole new topic. But a trend over the last decade is there's been a whole new type of player come to the market. It used to, as I mentioned, be just venture funds, corporates, and families doing venture. Over the last 10, really 5 years, there's all these new players, from sovereign funds, from hedge funds, mutual funds, from the number of corporate venture arms has increased dramatically. So it's really changed.
And they're playing directly as investors in the space.
They're playing directly as investors. They're investing in venture funds. They're doing all types of things to get exposure. They're sometimes doing secondaries themselves. It's really made the market a lot more dynamic. And from our perspective and from our strategy going forward, these are all groups we can buy from and we can help. And our strategy is a solution to provide liquidity. So we try to create win-win solutions. If you, Greg, had a successful investment and you have a 2x return, but the company's going to stay private for longer, we can help you by buying that. So, in a way, we try to pitch ourselves as a solution provider.
So I guess what is the how does that change the return profile? I mean, there's plenty of late stage venture investors that do Series B and Series C. How does the secondary positioned fund operate? Like, how is the return profile different than those types of funds? Do you get a better IRR, I assume, or maybe your multiples might be lower, but IRR is bigger, or less downside risk? How does the profile change because you're in secondary?
It's a great question, because it's one that we've been addressing since day one, is really why a limited partner would want to invest in our secondary fund rather than go directly in a venture fund. And our pitch and why we've been successful raising capital from pension plans and families and corporates throughout the world is really, we're saying we're going to get you exposure to what we think are the best private venture-backed businesses in the world that are growing above their peers, that have great margins and huge addressable markets, and ultimately have a good exit. But we're going to go about it through our secondary strategy, which is coming in late and really focusing on a safe 2 to 3x return, a very safe 2 to 3 to return. And then very importantly, we focus on principal protection. So we do not want to have any investments do less than a 1x in a down low case, that 20%.
Like the worst case scenario is 1x actually. So like venture capital, worst case scenario is 0, right?
That's exactly right. So if you're an investor in an early stage venture fund, you're prepared that fund is going to have maybe 5 out of 10 investments go to 0. And we're saying, no, we just want every investment to at least do a 1x in the worst case scenario. So we spend a lot of time on that low case, but really that most of them are just going to head up in these 2 to 3x returns. And we're going to have plenty of outliers that are going to do well above that in the 5 to 10x range, which our track record proves. But we're telling you as a limited partner, hey, we're a safe way to play venture.
If I'm investing in in like an industry or in secondaries, what is the ratio? Like, how many are 1x, which is your worst case, and how many are like 10x?
Yeah, the majority of investments, the 2/3 of our portfolio are at least 2 to 3x, and then we have less than 10%, well less than 10% that are 1x or below. And so it's our schedule of investments and returns is very different in a venture fund where, as I mentioned, you'll see some doing 10, 20, 30x, and then up to 0. You're going to see a lot, just majority 2 to 4x returns on all our deals. And that's really what our LPs, these state pension plans, these families have really liked, is it's a stable, tight band of returns that we provide.
And does that means that your asset class, I guess, like venture secondaries asset class, is not so much directly in the venture category, because I guess venture is usually looking for, as a bucket, is kind of like looking for some outsized risk. You're kind of in between venture and what would be on the other side of that spectrum? Like you're closer to sounds like you're closer to another asset class, I guess.
Yeah, that's a good way to think of it. I mean, of course, fixed income is a way to play very tight returns. It's a little bit more of an IRR play where, a fixed income a general partner would say, hey, we're going to promise you 8 to a 12% compounded returns. We're a little bit in between that, but of course we're underwriting to a 30% compounded return and at least a 2 to 3x. So we sit in between that stable kind of high yield play and probably the high beta, the high risk venture.
Okay. So you mentioned the kind of like your origins and how things were like 10 years ago. Is there some, it sounds to me like macro wise that there's some big parallels right now. I mean, we had this kind of big downturn. We have an inverted yield curve. We have a shift in like the allocators and the various investors are looking at different, there's a lot of move towards liquidity. There's a lot of other things happening today. Can you give us a comparison of like, I guess the venture market secondaries is forecasted to get to past 130 this year, 130 billion. How does this market compare to, let's say, 20 years ago when you started and when you guys get started? Because, as we're doing, my firm is doing early stage venture and some and secondaries as well, but much earlier stage than you guys. How is this market different or the same as 20 years ago?
Yeah, really good point. And I think that's one of our differentiators, and that's one of your differentiators, of course, is that we're both in the venture business in the late 90s, the secondary business in the early 2000s. And really our strategy was founded from the ashes of the dot-com crisis, which has a lot of parallels, as you mentioned, to what's going on today. And I was in a venture fund in the late 90s, and my co-founders were in the venture fund in the late 90s. And what we found was in the late 90s, early 2000s, like the 2018, 19, 20, 21 time period, is the market for venture was overfunded. And it became
How overfunded?
Probably over 2x overfunded, at least.
But like, what are the volumes for the listeners to understand how big we're talking about?
And it's an amazing comparison, but in the early 2000s, probably about 50 billion or so, 60 billion was being invested per year in venture. And then that got cut dramatically to 20 billion, 30 billion a year in 2002 and 3 after the dot-com crisis. The parallel today is that's more than 10x. So over 300 billion was invested in venture in 2021. So almost 10 times.
Just 1 year, 300 billion.
1 year. And that probably, as you ask, should have been around 100 or 150 billion. There's a lot of private companies that raised more money than they needed, spent too much. There's a lot of companies that shouldn't have been funded. And what's happening today, and it's going to happen over the next 3 to 5 years, we really think it's going to take a while to play out, is those companies with these cash balances and the ones running out of money, there's going to be a readjustment where just the top companies in each sectors are really going to survive and have good exits.
Yeah, I think Dor had a great quote early in venture capital. He said, there's always money for good companies, but in some markets, there's also money for everyone else as well.
And that's exactly what we saw in the last 5 years. And so
when you say that they were overfunded, is that what happened by overfunding? That means that the valuations were too high. There was overspending. That means that in this next couple of years, you're going to expect venture, the secondary prices to be very low, and also the primaries to be low, or primaries to go away and they'll just go out of business, or how do you foresee the next 2 years in this from this perspective?
Yeah, so probably all of the above. What we all know happened, of course, in post-COVID 22 is that the public technology companies that were traded on the public market that are comparable to a lot of these private names, their valuations got cut in half, and sometimes were down 2/3. And so instead of these high growth, high margin software tech businesses trading at 15 to 20 times bookings and revenues, all of a sudden they're trading between 5 and 10 times for the most part. The private
in the public markets.
In the public markets. And so what happened was all these private companies, when these companies were trading at those values, raised their money at those metrics. So private companies were raising at 20 times revenues. And so all of a sudden, after the public markets have corrected and basically have stayed flat for 2 years, they've started to come up a little bit and the metrics have improved, is all of these private companies that are late stage that raised capital over the last 2 or 3 years are over half overvalued. And so there's this correction going on. And the reason it just takes time for these private markets to adjust is these companies have 12 to 36 months of cash. So they're typically sitting on the books, the scheduled investments of these firms at the same values, the last round values. And sometimes general partners are marking them down. Sometimes hedge funds are marking it down. And we've seen some in the news about markdowns, but the vast majority are still holding it at the last rounds. And so if you apply a metric, you can see, hey, they're holding it at 20 times revenues, but the public comparable is trading at 8 times. So
why would venture capital firms keep it at the same markup? Because I know it's a most common practice, and I see some reasons for it, and I see some reasons against it.
Yeah, and that question is really the thesis behind our whole strategy, is that different shareholders of the same private venture-backed businesses are holding it at different values. If you hold the shares in a publicly traded hedge fund, they're going to market to market every quarter for the most part, market down. And we've seen a lot of markdowns. If you're a venture fund and a GP and you're doing annual FAS analysis, you can justify that sometimes by using different comps or maybe M&A comps. And a lot of times we're seeing GPs hold the same asset that a venture fund marked down 50%, they're holding it still at the same value. So when we go source or try to buy into a business, obviously it's better to buy into from a seller that's holding it at a lot lower value, and then our discount isn't as much. And so the nature of the private business that we've seen on the venture side is just everyone thinks their private company is valued differently or worth something else. And so we're out there trying to pick and choose of the right sellers to buy from.
Right. And so who's the most common seller? Like, who do you usually buy a secondaries from?
Yeah, there's the sellers, and to my point about the different players in the market, is a lot of the newcomers that relatively new over the last 5 to 10 years. So the huge growth in corporate venture arms from 100 to over 1,000 today, huge growth in families.
1,000 corporate venture arms.
Over
so you
the
have
world.
like people inside companies that are doing venture capital management.
Correct. Yeah. So in the late 90s, it really was General Electric's venture group, GE Equity, Intel Ventures, Cisco Ventures. Those were the high profile ones. Now, as you mentioned, and there's over 1,000 investing off their balance sheets. And so we've seen a lot of corporates come to the market recently, come to the secondary market and say, hey, we invested $50 million in these 10 companies. We've realized that they're not going to get acquired for the next 3 years. We actually need cash to run our business. Can you buy our assets? So corporates are a big seller. Hedge funds and mutual funds participate in venture with the hope that a lot of these companies would go public and so they could buy in the IPO. And of course, IPOs are down and they don't want to wait 2 or 3 more years. And so it was such a small part of their portfolio. We're seeing hedge funds and mutual funds step up to the table and sell. And then employees and founders have always been a big part. And a founder of a business may have been making a salary for the last 10 years, but has a big chunk of equity and they want to monetize it. And so they're now coming back and accepting our pricing. And so we didn't do a lot of direct secondaries in really over the last 3 years when valuations were so high. We pivoted and found better value through LP interest, but now we're seeing a lot more directs come our way with founders willing to take our pricing.
And you see, didn't want to wait. You keep mentioning over and over, like they don't want to wait. They didn't want to wait. So I guess, would you characterize the ethos of your business as we're slightly more patient traders?
Yeah, and that's a big trade-off. So what we're offering is to them the time value of money. Yeah. So we could go to you, Greg, and say, hey, you own 20 million in this business on paper, that's valued fair market value today, um, but you could wait 5 years when your company's going to get acquired, and maybe that's going to be worth 30, but that's 5 years from today. Or you could take our 12.5 million for your 20 today. And so it's this trade-off, not only
Right.
time value of money, but it's also risk. Like, hey, Greg, it might not be worth 30, it might be worth 10.
Yeah, market can
In 5
corrupt.
years. So we're
There
obviously
might be a
taking,
war. There might be
yeah,
a inverted yield curve. There could be all sorts of stuff that come
right.
out.
So your sellers are taking our pricing
Yeah.
for this time value money trade to take some risk off the table. And on the other hand, we're trying to mitigate the risk, of course, by going to these businesses that have all these characteristics we look for.
Yeah. Yeah.
Yeah.
Great. Great. And is your feeling that venture capital firms that are doing normal venture capital strategy, let's say Series B, Series C type companies, how are they going to do? Like, is venture a good category right now, or is it going to be a good category over the next 3 years? Like everything from seed all the way up. Like, I guess there's like, it's been a tough, with all the overpricing before, it was tough. But is now a good time to be doing venture capital investing or in venture capital fund investing? Let's say take secondaries even off the table for a moment. Is venture a good category right now?
Yeah, and really good point. And our whole firm is based on that thesis that venture, we think, is one of the best places, and that every asset manager should have exposure to venture, whether it's through secondaries or through a strategy like yourselves doing a little more early stage venture, or through the other strategies we have at Industry Ventures, which is a hybrid fund of early stage funds and a direct co-investment fund. But
Right.
venture, the thesis we have and stand by, and I think anyone in the business, is venture is an extremely exciting place to play.
Right now.
Right now, there's going to continue to be great returns, whether you do it through secondaries or venture funds or fund of funds. And it's largely the disruption we're seeing with technology, disrupting existing technologies and marketplaces, the huge the total addressable markets these companies are creating and addressing is bigger than we've seen before. So developing a successful product or service, whether you're selling it to a business consumer, now can sell globally. The the rate of M&A we've seen from strategic. So venture, of course, needs exits. So despite IPOs coming and going, we've seen a huge amount of strategics wanting to, these existing incumbents, acquire these new technologies. And then not only that, but a big trend has been private equity firms now are acquiring and rolling up venture-backed businesses. Almost 1 out of 5 venture-backed business now is being acquired by a private equity firm, and there's been a lot of capital. So
they're
venture
actually buying a almost profitable or a profitable company, and they're rolling it up with others to make an exit for the venture guys, but a bigger play for private equity.
Yeah, and then the private equity will sell it to a strategic or take it public, and it'll be a platform. And so this has been a huge trend. So venture has, if you look at the IRRs and the multiples over the last 20, 25 years, has been outperforming most other asset classes from a medium to longer term basis. And then going forward, you can just see these huge disruptive technologies, the incumbents that are going to need to acquire these technologies. So we're really bullish and excited about venture going forward. And we think that this correction is healthy. The market needed this because it was being overfunded, and there was a subset of companies that shouldn't have raised capital. So it's going to play out over 3 or 4 years, and we've seen this play out, like we did per your question, in the early 2000s, and it's all healthy.
So do you think that this is an asset class, venture capital and venture capital direct secondaries, that family offices or pension funds or fund of funds or corporates will start allocating more to this sector at this moment, or will they tend to go towards other more liquid asset classes, or maybe they should be going there, but they will go liquid? I don't know. Like, what do you think's the dynamics of the the LP and the family offices, and then over the next kind of 24 months? And like, what would you say that they are looking out for, or they should be looking out for?
Yeah, it's a good point. The vast majority of, or at least half of state pension plans and families still don't have exposure to venture. So when
Okay.
the other hat I wear here, as you mentioned, is helping to raise capital, build relationships with all these different LPs over the world. And we've seen this trend over the last 20 years is that pension plans are more and more getting approval to invest in alternative asset classes away from
Okay.
just public equity, fixed income. So venture is part of that. And so we're
Right.
seeing venture allocation from 5 to 12%, 15% of these plans, and that's sticking.
Okay.
We're seeing families getting more exposure. And then the other, of course, is these private client asset managers that manage high net worth money is getting more exposed to venture.
Mm-hmm.
But the healthy thing about all of it and what we've seen is that now state pension plans and families every few years are readjusting their venture portfolios and private equity portfolios through secondaries.
Right.
The liquidity
Secondaries is like the great equalizer of like they can rebalance their portfolio when before they just had to kind of like stick it out and just wait 10 years. Now they can actually
exactly right.
make adjustments.
They can say, hey, we're going to sell a pension plan can say, hey, we're going to sell these 10 commitments we made to these old venture funds and generate a 2x return. And then we're going to roll some of that capital into making commitments to industry ventures on the secondary side and some other venture players going forward. And so the secondary market makes it easier for a lot of these different investors to play venture because now they can sell investments like instead, as you mentioned, they don't have to stick it out for the duration.
What is the profile like if an investor is investing in venture, like how does the investment work? Just maybe there's some family offices or there's a allocator online that hasn't done allocation venture before. Like, what is the dynamics of that investment, and how does that make sense compared to like other types of assets?
Yeah.
Like, how long is the money held up for? How does the money get drawn down? Do they, if they give you $10 million or $100 million, you like, is that 10 million they send it to you day one and then you invest it, or how does that work exactly?
Yeah, and that's a good point, and that's one of the reasons why historically it was mainly pension plans who are flush with capital who have been the LPs, but now with all these different players playing venture, the first way to really play it rather than going and investing in companies directly, which of course, as we talked about, is very risky, is to give it to a fund like Industry Ventures or other venture funds. And how it would work is we just raised 1.45 billion for Industry Ventures Secondary 10. And so we went for about 6 months and talked to investors all over the world, and we were trying to get commitments. And so from a typical state pension plan, we'd say, hey, can you give us $50 million and we'll commit to our Fund 10. And how that works is we will call their 50 million typically over a 2 to 3 year period, which is how long it takes us to invest our funds. And we'll do a first call of 10% of their commitment. So on day one, we'll find some deals and we'll call 5 million from them. And then over that year, we'll call another third of their commitment. And so our investment period of this 2 to 3 year period. And then once we are fully invested, so we've filled up the 1.45 million with deals we've purchased and commitments that we've made, we'll spend the next 5 years or so, kind of the harvest period, trying to get our capital back. And so as soon as we have exits, we make distributions back to that LP. And then we'll go back to the market and we'll say to that LP 3 years later from now, hey, we've returned your money. We've given you some returns. You still have a nice multiple on paper. But now we're raising a new fund and we'd like you to commit and we'll give you more exposure. And so,
and when they commit, they're committing I guess you're taking standard fees. What those fees would be 2 and 20 or something different,
Yeah,
or
typical venture fund is 2 and 20. We're below that because we're a hybrid. And so we've
okay.
worked with our LPs on the right balance because we do secondary directs and LP interests. But yeah, there's a management fee. And then once we return all their capital, there's a percentage of the profits, the carry that we get as well.
And so does that mean that your management fee actually is dynamic based on how you allocate?
It's a little bit. In the
Okay.
typical management fee in the venture business and the secondary business is that you get a percentage of the fund size as you're investing, the investment period, and then it
Mm.
switches. It's dynamic. It switches more to a percentage of the remaining cost of the portfolio. And so
Right.
different venture funds, different asset managers and alternative assets do it differently. And so it's an arrangement that we've made with our limited partners, and of course, it's in the limited partnership agreement.
Cool. Cool. So what does your day look like? What is it that you are doing as Justin Burden at Industry Ventures? Is like what's like an average week for you? Who are you talking to, and what type of interactions are you having?
Yeah, good question. On a day-to-day basis, week-to-week basis, we have some core goals in my core goal, but one is really to source secondary transactions. And so it's talking to the pension plans that we raise capital from about if they have other assets they need liquidity on. It's talking to uh, people in the bankers and research analysts in the market on what the top private companies are. It's talking to some of our 800 general partners, 800 venture funds that we've bought stakes in over the years about how their portfolio companies are doing and whether we could buy into any of them. It's talking
Okay.
to those general partners about their older venture funds and whether we can help restructure them. So at least a third of my time is sourcing. The other third of my time and our team's time is diligencing these, is
Hmm.
talking to board members, is talking to potential acquirers, talking to private equity firms. What would you pay if an M&A process? What are you seeing in the market? Is this
Mm,
company worth 5 times? It's talking to
right.
competitors. And so diligencing is about a third. And then the other third is just the general processes of working and running a secondary fund on team dynamics, how
Hmm.
we can be effective in the marketplace, how we can source better. One of the things we've done in our secondary team is built up a business development group. A lot of the big
Right.
private equity firms have dedicated professionals that all they do is source. And that's one
Right.
thing we've done over the last 5 years is now we have this 3-person business development team. So
What
it's a really dynamic uh, industry to play in.
Cool. And when you are sourcing these deals, what is a type of what's like an example of a discount that you might pay for that asset? Like either off the last round or off the market pricing or the comps. Like how does how do your LPs like look at you and say, hey, oh, this was a good discount or this was a bad discount? How do you frame it and how do you look at it yourself?
Yeah, and that question is a challenging question to answer, and it's the question that we've been getting since day one, 20 years ago, from potential investors: is, hey, what discount do you pay? Uh, we really are focused on getting this two to 4x return in the base case, and 1x in the low case. So regardless of where the seller is holding that particular asset, whether it's a limited partnership interest we're buying or a position in a direct company, is we do work around what is that exit and talking to the potential acquirers, strategics, talking to the private equity firms, or looking at the public comparables if it may go public and talking to bankers. And so since every shareholder and every type of investor typically is holding these venture assets at different values, especially today when there's all this volatility and noise in the market, sometimes we can go pay and have to pay a 60 or 70% discount because the GP maybe even marked the asset up like they shouldn't have.
Right.
Sometimes we come in and pay a 10% discount
Right.
because the holder whacked it. So a lot of times we're buying into the same business at the
Yeah.
same dollar price, but at very different discounts. But in general, what you're getting at today is we're buying assets today off of second quarter end marks from
Hmm.
GP and corporates, and we're typically paying 40 to 70% off right now.
Right. Okay,
In
40%.
general.
And what are the sectors that you focus on and don't focus on? Like, what are your like top 3 sectors that you've invested in this year, and what are the bottom, like, we don't touch that industry, or we don't touch this or
Yeah,
that? But
no,
what
it's
is
good.
industry ventures? Because you guys are a very big player, 6 billion under management or more, I guess now. Um, what do you focus on?
Yeah, so it all goes back to the characteristics we look for in a business, an
Mhm.
already successful business that you can really predict stable growth, stable returns. And so, what that means from a sector perspective is we really like software businesses, enterprise and subscription SaaS software businesses, because they have
Yep.
recurring revenues. And you can look at the businesses or the
Yep.
consumer that they're selling to, and there's value in recurring revenue and really predict it out. We really
Yep.
like fintech type businesses, payments, and marketplaces, because you can see this recurring nature of the business.
Right.
Excuse me. On the flip side, what that means is um, consumer businesses selling products that are hit driven is very challenging. We've done them, but it's very
Right.
hard to predict going forward. Capital intensive businesses like biotech and
Mm.
medical devices or
Yep.
semiconductors, kind of hardware plays, are very challenging because they're always having to reinvest in the next product. And so those typically are not fully financed businesses.
Hmm.
So we avoid those businesses as well. So really it comes down to technology businesses selling to other businesses where you can see this recurring nature of
And you're a generalist. I think when we spoke before, you had mentioned, do you partner with others for the specialty sectors, like the sectors, like if you do something in healthcare or you do something in fintech, like what is your normal, do you club, or is it everything on your own?
Yeah, it's a combination of the two.
Okay.
More and more, we like to have partners. And
Right.
typically, the partners, if it's a secondary direct deal, is someone who's already an existing investor, a shareholder, a venture fund will partner if it's a big block and we can share information and it's a good validation of the price. If it's a
Okay.
big portfolio of LP interests, we'll partner and a lot of times with other secondary funds, sometimes the bigger secondary funds that focus 95% on private equity and 5 on venture will look to partner with us, and we can share our expertise on the venture side. And some of these are 100 to $500 million portfolios, so it makes sense. And so um, it's really a combination, but sometimes we'll have the angle on a business. Maybe one of our general partners has already invested in it, and we've been tracking it, and so we're very comfortable doing it alone.
Hmm. So do you do AI investing?
On the secondary side,
Not
the,
yet.
the way we're playing AI is really that our existing portfolio companies or some of these late stage software and technology businesses are bringing AI into their solutions.
Hmm.
We're not playing it on the early stage side, of course,
Of
because
course not.
there's a lot of venture risk still associated with whether these products are really going to be able to monetize.
I guess the same goes for like Bitcoin or digital asset related businesses. It's still too early
Yeah,
for
and
you
as
guys.
we talked about over the years, is we largely avoided crypto and Bitcoin with just the typical venture and market risk around it.
Well, your return profile is much more conservative for that kind of volatility, perhaps. But
Correct.
but I guess with the emergence of it, I mean, it keeps growing quite a bit. Do you think maybe 3 to 5 years it might start entering your frameworks? I mean, there is definitely some 10 and $20 billion entities there.
Yeah, I think it will. There's no question that, especially AI,
Hmm.
will come our way with
Yeah.
businesses that have 2 or 3 track records of recurring revenue. You can really see the stable returns. It's going to come our way, and that's what we like about our business in general. Is we're not taking that initial product or market risk that AI has. It seems like it's broken through that today, but
Right.
we really just want to go across these businesses that have been executing for 7 or 10 years and have customers that have been around for five
Yep.
years. And you can see that there's upsell and cross sell going on, and this predictable returns. And so obviously some LPs want exposure to that venture risk and trying to get that 30x
Yeah,
returns.
of course.
There's a different
It's
way.
a different group.
Right.
Do you invest in companies that are not yet profitable?
We do, but one of our characteristics and tenets is really to buy into businesses that are at least break even or have enough cash to get to break even. And that's really an important difference over the last 5 years is that if you were a later stage business, it was almost a given that you could raise a subsequent round of venture financing.
Yep.
And so the financing risk wasn't as present. But for our first 15 years through the 2000s and up to 2015, it was hard to raise capital. And that's why we really wanted to buy into businesses that were fully financed, had enough cash to get to break even and were break even. And we're really going back to that today, because I think one of the things we're going to see and we're seeing now is over the next 3 to 4 years is it's going to be challenging to raise capital again. The companies are really going to have to prove
there might be no capital for some of these companies.
there might not be capital, and it's going to be healthy.
So let's go to the other side of the table. If you're a CEO or an early stage investor, or you have an angel portfolio and you want to think about secondaries, like what should a entrepreneur, a CEO that's either selling or one of their investors says they're going to sell, or you're just a family office or a corporate and you're like, oh man, I think I want to exit. I need some cash, or I want liquidity, or it looks like my cousin's trying to get liquidity in my company. What are some considerations about like finding that deal, considering who they're going to go to? I mean, you've clarified what your profile is. Is there a market for this? Is there someone to call, or like what should they consider if they're just considering secondaries? Maybe think broader than just industry.
Yeah. So if you're a individual that has exposure to a company that you founded or invested in, your family likewise has exposure to a venture-backed business or even a venture fund. One of the big lessons over the last 3 years and lessons from the dot-com crisis is it's almost impossible to time the top, and taking money off the table on an annual basis or locking in and monetizing a return is a really smart thing to do with venture. There's so many unknowns.
So you're saying to monetize a return, like maybe it was up to 10x and now it's only up 3x. Maybe you should monetize that now in case it's going to go down further or be just illiquid for another 5 or 10 years.
Yeah, some of it, not all of it. So if you're have 50 million of unrealized value in a venture-backed business or portfolio venture businesses, it's, hey, let's take 5 million off today. It's not what it's going to be worth in the future, but it's a smart thing to do. Let's take 5 million off next year. And so a lot of the companies that we've bought secondaries in is we build relationships with the management teams and we continue buying over subsequent years. Even if we have to pay a higher price, the company's grown, it's come out with new products, the value's increased. So we'll continue to build stakes. And our goal really is to get really smart about these businesses and be the liquidity solution provider. And so likewise with the seller is we could come back and buy from you or the same seller over the years. And so it just makes the venture business more dynamic, having this little bit of a market in there.
And what are the things in a seller that would influence the price? Like why would I sell it to you at a discount to the round that I just had? Like there must be dynamics with what type of class share they have, or whether they have a majority or minority, or what are the types of things that will where I would understand that I'm paying at a discount. It's not just because I'm getting there's a low price, but there could be dynamics around why I would have to accept a different price than the last round.
Yeah, and we could do a whole podcast session on just that topic.
We've only got 10 more minutes, so you got to speak really fast. I can put it on 2 times speed. But
secondary directs, as you're implying, can get really complicated, and especially when there's these different series of shares within a cap table. So if you're a founder, of course, you're buying common shares or own common shares, but your investors who invest in your companies have preference above you, senior. So, and there's different layers of preference, Series A, B, and C. And so sometimes buying common shares, we can buy it in a company that's raised very little capital, maybe raised 10 million, but it has 100 million of revenue. That's rare. But at that case, the common shares are worth
fine.
almost the same as the preferred because there's only 10 million above it.
Yeah.
What we're seeing today, though, over the last 3 or 4 years is a lot of these late stage companies, the over 1,000 venture-backed businesses worth over $1 billion, a lot of them have raised 2 or 3 or $400 million. And so if you're a founder and you say, hey, I want to sell some common shares in my business, it's worth $1 billion. And we say, well, there's 400 million of preference on top of your common. And we think that actually your business is going to be sold next year for 300 million. But, we're going to pay 0 for your common because the preferred's going to come off the top first. Not only that, but of course, there's a whole nother topic of venture debt. And venture debt has been a big part of these companies' use of generating capital to grow. Is they'll raise money from venture funds, then they'll go to a bank or a specialist venture debt firm and say, hey, can I have 30 or 50 million? And the debt sits senior to the preference. And so sometimes, if we go buy shares, a lot of the founders who maybe are no longer with the business, don't know that there's 50 million of debt and another 300 million are preferred. And so that their common's worth very little. And so, going back to your previous question, that's why it's smart if you're a seller to monetize over time, because these different...
You never know. You don't know if it's going to go up or down. You need to account for some variability and some illiquidity. I mean, there's always an illiquidity discount as well. Like, you can't, it's harder for you to sell as well as me.
Right.
Do you think that how do you take in, like, do you take into account like black swan or future recessions when you're evaluating these companies, or are you?
Do. Yeah. I mean, in our early days, we'd do a Monte Carlo analysis and look at all these different scenarios and, whether there will be a recession or whether the cost of capital on the debt side will go like it has from 3 to 9%, or whatnot. But how we look at that low case is really, is there a residual value in this business that someone's going to want to acquire, even if growth slows down, deaccelerates, or some competitors come in and take out the product? Is there a residual value that's something worth? And that's where we really hone in on trying to get a 1x. And there's a lot of businesses out there that don't have a residual value. If you don't come out with a new product,
they're dependent on growth and they're dependent on consumer, spending going up and that kind of stuff.
Right. Exactly. And that's the trickiness of the business. If you're a institutional board member, investor in a business, you're a founder, when is the right time to sell? Right. And venture funds are 10-year vehicles, as we talked about. So there's going to be pressure from venture funds to get out in that year 5 to 10.
We're finding very good opportunities with venture funds that are basically just, they're looking for some stripes of their portfolio to get out, even in the mid stage, early. Like, I know you're much later stage, but even in the growth companies that, like EBITDA is on the horizon and the growth rate is still, aggressive. And they've got a bunch of money in the bank, but they still, they need to have some exit.
Right. Exactly. And that's where we can come in, of course. Or the board can start an M&A process. And get it out. And you clearly, you don't want to sell at a time of weakness, like when a company could be running out of capital, because the buyer is going to know that there's no other options. And we're starting to hear about it over the last couple months. Is some of these companies running out of money and having to sell for low values, and we're going to see that play out over the next few years. And so, from our perspective, there's a lot of traps and danger out there. And so we are just having really flight to quality and only wanting to get exposure to these top businesses that aren't going to go through those scenarios.
Are you using AI in your business? Like, will you use it to source things or to modify your internal business, or is it pretty far away from you guys in your guys' style?
We're having conversations about it. One of our proprietary ways of sourcing and leveraging our network is looking at our data over the last 20 years, all of our exposure to over 800 venture funds, our portfolio companies that not only we've bought into, but have looked at and have data on or have conversations. And so we're constantly mining our portfolio to look for signals of what great companies are or
Yep.
where we put our capital. And so there's a little bit of an AI component to that. And going forward, that's going to be a larger part of how we source.
Okay, cool.
Yeah.
I guess is there any question that I should have asked if I was much more clever than I am, and that to understand this this sector a little bit better? And
yeah, go. Well, I think you covered it in the beginning, which is there's a few themes playing out today that aren't new.
right.
And even though it appears new and we're confronting uncharted territory, we've really seen this play out before. And a firm like Industry Ventures that has been around over 20 years now, and as you mentioned, have raised and invested over six billion capital under management, is the correction we're seeing today is very similar to what we saw in 2002, 3, 4, and 5, where the venture business was very exciting still, but overfunded. And it took 5 years for the private markets to readjust from a valuation perspective. And we're seeing that. We're in the early innings of that correction.
And those vintages were unbelievable. All the like all the venture players in those vintages were solid next 5-10 years.
Exactly. It was great time to invest into venture during that correction, like it is now a great time to venture. Is a great time to invest in secondaries back then, like it is now. So that's one theme I think is really important. Is we've seen this play out before. We have a playbook. You have a playbook to do this, and from a limited partner perspective, it's a great time when others are retreating to come in.
Yeah.
And then the second theme, of course, is just what an exciting asset class venture is. There's a lot of different ways to play it. You can play it with venture funds and get these outsized return potential. You can play it with a group like ourselves, which is a little more stable. And then third is just the market in general and the exits for venture-backed businesses we've seen dry up a little bit, but there's no question that IT spend, if you look at the big and how the big Magnificent Seven is doing today, the big tech players, they're going to continue acquiring these businesses, and the IPO markets are going to open up again, and it's just a question of when.
Yeah, for me, I'm in some VC funds too, and as well as obviously we run the fund where we're doing early stage and we're doing secondaries. But one of the things I like about venture investing in the funds is that I can make some the funds I don't do so much generalist funds, but like the ones that have some specialty, like we're like financial markets ecosystem. There's ones that'll do very, 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 very focused. It could be like a Bitcoin technology fund, or it could be like a healthcare fund, or it could be like a, European fintech fund, or it could be like a global like e-commerce fund. So if I have macro feelings about where things are going, I can actually make I can make a bet with some people that are thinking about this 24/7 and are taking the speculative bets. Whereas, I'm as a family office or as a person, I can get wooed by one deal. Like the CEO is very, charismatic, and this looks like a good deal. And I haven't been in this space. I don't realize that there's 4 competitors that are 10 times more successful than him already, in one country over. And I just don't have that day-to-day exposure to know that. So I'll write him a check and then realize that it's not the top 3 player. Whereas when we go in with VC funds that have, especially like you with your broad-based, no downside, very limited downside secondaries, us with our growth secondaries and fintech focus, with healthcare company. I can really kind of make those decisions and diversify my personal portfolio without, going to QQQ or being like just giving it to a wealth manager or something like that. It feels like a very fun. For me, it's been a very fun sector, both as an investor and as a manager.
Yeah, I agree, and that's why we're in this market, and in general, venture, like you said, is there's a lot of traps,
Yeah.
because you may not know about who the competitors are. You may not know, like you said, that someone's taking market share from the company you're being pitched.
Right.
Excuse me. And so the way to play venture, right, if we were to recommend is, hey, go through a fund because they're going to have a diversified basket of assets, or hey, go through a secondary fund because they're going to have more stable returns, and then maybe you can play some one-off companies here and there over time.
Yeah. Can you one question related to kind of like some of the numbers and stuff you had said before? Where are private valuations decline, and where are the private valuations, and how do they compare to like the last 10 years? Like, where are they now?
Yeah. Today, we're seeing later stage businesses raise new rounds or new capital more closely associated with where these public comps are trading, which is 5 to 10 times revenues, 5 to 10 times current year bookings.
Yep. And that's a low, right? That's almost like that's maybe a 10-year low, right? As a
It,
multiple.
yeah, it's still, if you look at the historical metrics, it's still on the high side.
Okay.
But from a relative over the last decade, it's at a low point.
Okay, so if you look at the 20 or 30-year horizon, it's high, but on the 10-year, it's the ultimate low.
It's relatively high. When we
Yeah.
first started doing it, and this is one thing that is shocking, but we used to buy into businesses in our first couple secondary funds at 1 to 3 times revenues.
Yeah.
And that's really what was going on back then. Obviously, these businesses are growing more. The addressable market's bigger. The margin profile is better. So there's reasons to justify the higher multiples, but we're really back to where we should be, is this more normalized metrics, both on the public and private side.
I'd say that a pretty good reason for that is not to justify it anyways, but the dynamics when you guys started, when industry started in like 2001, 2002, 2003, that was just the very beginning of liquidity at the top end of tech. Basically silver. Basically you had the very first PE firms for tech were 1999, right?
Yeah.
Silver Lake, entered at that point.
Yeah.
And then, so over those 3 to 5 years, you started getting this kind of like high-end liquidity up at the pre-IPO stage, or like from the late C up to IPO, where they could actually pay do billion-dollar buyouts and do the stuff that you've been doing in traditional markets and now 20 years later, I'd say 95% of all PE shops have a technology focus. You can't really do PE without some tech angle.
It's really been a great aspect of the exit market for venture-backed businesses, like you say.
Yeah.
But originally the only groups that acquired venture-backed businesses in the late 90s, early 2000s when we started were strategics.
Yep.
And so Silver Lake and then Vista started in the early 2000s, and Thoma Bravo. And then, as you mentioned, all the big buyout firms today are either acquiring them out of their main funds or have dedicated tech buyout funds. And we've played that trend, as you're aware, at Industry Ventures. 5 years ago, we started a hybrid fund of private equity funds that are buying tech businesses. And we're funneling them, our portfolio companies that we own directly and indirectly, to these GPs, and we're co-investing. And there's been this next generation of private equity funds in the $200 to $700 million range that are buying these $30 to $50 million software companies for great prices and rolling them up. So we saw that trend. We had our LPs reach out to us and say, how can we play that with you? And so we just raised our fund 2 about a $260 million vehicle to go after that. Different team than what I'm on, but the secondary team is we're funneling them deal flow. They're helping us having our portfolio companies find an exit that otherwise couldn't.
Super, super. So this is just to review the secondaries direct market size. I think what did you say it was?
Yeah, you mentioned it a little bit at the beginning. Last year it was approaching over 100 billion. This year it was predicted to be well over 100 billion, but we're seeing it kind of back a little bit flat to last year, but still 100 billion, which is multiples of what it was. And so that 100 billion size is both secondary directs and secondary LP interest and continuation vehicles. So it's all three types of liquidity tools, which is what we do, which is very unique because a lot of the other players out there just do one or the other, and we do all three.
That's fantastic. Yeah. It's a good. I guess it's been an exciting ride, and I actually I went to undergrad with one of the co-founders of your firm, and I was like close to you guys in the early days, actually, working with you a little bit in Europe, and I'd say that the importance of secondaries has become more and more dramatic, and I think that it's underplayed in the venture market, even with your success in some parts of the sector, in some sectors where that aren't quite as robust as like the bulk of your portfolio. There is you get this benefit of very little competitive tension. If there's not that kind of like, if it's an LP interest, for sure there is, but competitive tension tends to dissipate in, like as you go down the value chain or you go to specialist angles. And so it's been exciting to see that, I see this kind of happening. The same thing that happened to tech is happening kind of like to the financial markets ecosystem. Those companies were not, traditionally invested in by all the VCs, and now they're getting more and more transaction-based, scale-based companies. So it's kind of exciting. Well, I mean, I want to be careful of time. I think you were super generous to give us all this time, Justin, and it's been a fantastic conversation. I'm super grateful that you came. What do you is there any parting words or anything you wanna review, or is it time to get back to work?
Greg, thanks so much. You hit all the key topics. It's really great and very topical for today as we're going through this correction. And as we talked about, it's not unprecedented. We've seen this play out before, and I think it's really healthy. And there's a lot of subtopics that we could follow up on, but Industry Ventures has really appreciated the relationship we've had with you, Greg. As you mentioned, you've been a longtime friend of the firm, and there's a lot of ways we can collaborate. So look forward to it, and thank you for having us as part of this.
Hey, it's been a lot of fun. Thanks for coming.
Great. Look forward to next time.
Cheers.